Trent Bradshaw, Brandon Rogers, Bradshaw Financial Planning, and Mind Your Money. Today, we want to come to you and talk about how President Biden could impact your retirement going forward. It was a presentation, Brandon, that we were going to have here in the office, but as has occurred before, with the COVID issues that we've got, we felt like this was a safer move for our clients and also guests in regards to how to present this data, because we do think it's important. We're going to get more clarity as we go into the end of the year, but definitely wanted to touch base on this.
Yeah, I had a lot of interest in it, so we couldn't do this in person, but we had a lot of different sessions we were going to try to do, and our room just wasn't big enough for everybody, so figured this was the best way to do it. But really good presentation we got set up today. Obviously, we'll ask some questions if you got anything after the fact, and we want to make sure everybody's addressed just like we were here in person. But we go ahead and jump into it, and I'll go over the agenda of what we're covering today. So first off, we basically have do not wonder. So one of the things that we'll look at, a lot of questions, a lot of concerns about, hey, what's going to be changing potentially in the next year and going forward. We're going to talk about the individual income taxes, how that might be impacted, along with the capital gains rate, dividends, taxes from that end. We're going to look at the corporate income tax rate as well, give you some detail and clarity around it and what we think might happen. Infrastructure spending, it's obviously a big thing on the table right now. Changes to Social Security, it's always changing, so we just always got to keep up with it. And then also look at changes to the Affordable Care Act, or they call it ACA, Obamacare, whatever you want to reference it by, but we'll give you some updates on it too, because we have some major changes this year as well. Okay. So the first slide that we're going to look at really just talks about a massive drop in the market, right? So when you take a look at this, I wanted to put this in kind of perspective, so to speak, because when we had the COVID downturn in the market, it seemed very uncomfortable, right? But then how does that really compare to maybe the Great Depression? I know that came out a lot with some analysts, things of that nature, that says, hey, how does that compare to that Great Depression? Well, if we look at that, the Great Depression during 1929, 1933, market dropped around 89%.
And that's severe. I mean, that is without a doubt. I don't even want to talk about it.
Yeah.
I mean, it's that bad.
Exactly. But you look at what happened in the March 2020 downturn, market fell about 30% during that time frame. Okay, so I want to point those out because it kind of takes us into our last slide, and I actually had a question to kind of let you think about it. So basically, the question is, how long do you think it took for the market to recover from the Great Depression? So think about that. We just saw the numbers. Great Depression was 89% drop, and we'll compare it to the March downturn last year. So if you thought about it, it basically took the market about 25 years to recover to get back to the pre-crisis level during the Great Depression. I mean, that's unheard of. I mean, that's why you saw people in that generation be, super savers, don't need that much, live on a very tight budget.
Well, no longer took a lot of risk either.
Yeah.
Right. That was another thing that popped up from that.
Yeah, just wanted the banks. They didn't want risk whatsoever. They have I always remember the butter containers instead of the Tupperwares, stuff like that is what, my grandparents had a lot. But,
Sure.
But when we take a look at that, as far as the Great Depression in 25 years, when you look at it in comparison to what happened in the 2007, 2008, the Great Recession is what they call it, the financial crisis, it took about 4 years for that recovery. But again, go back to the beginning chart that we looked at, when you look at what happened in that COVID downturn and it dropped 30% in that 3-week period of time, it doesn't even show up on the returns for the end of the year. The market got it all back and then some, and it doesn't really even show up. So again, I just wanted to kind of point those things out to say, hey, how long this stuff took and what the time frames were, because it's a pretty crazy drop that happened. It was a very fast recovery as well. So it's very interesting to see that. So when we get into the meat and potatoes of the presentation that we looked at, talking about some of these tax changes. So what are we going to see? Okay. So basically, we're looking at some things that are projected. So what do you think about that, Trent?
Well, we've talked about it several times before, but we do think Biden is likely to succeed in reversing the Trump tax cuts. There's going to be some level of adjustments there. For instance, raising the corporate income tax from 21%, where it is now, up to he's wanting to get to 28% based on the latest data. Mm-hmm. We feel like there's probably going to be a middle ground of somewhere in the neighborhood of 25%. but still it's a significant change over and above where we're at right now. So we do foresee the corporate tax rate obviously changing and going up from here. Increasing the tax rate for incomes more than $400,000. Now, one thing about that, the majority of the population looks at it and says, you know what, that's not going to impact me at all. Well, there's going to be what we view, some type of trickle-down effect to where there will be some impact at all levels. But yes, he is targeting incomes that would be $400,000 a year and above. And again, increasing the taxes in that realm, basically to focus on what I would call higher middle income to high income earners.
Yeah.
At this point.
I guess we just went to a conference recently and got an update from a well-known economist basically saying, yeah, I mean, the tax rate corporation might go up, but like you said, that trickle-down effect usually happens. Usually the corporations aren't the one paying the higher taxes. It's usually they pass it down to the employees and to the end product to what the consumer's buying. You know,
it's very interesting that you mentioned that because in that conference that we went to, basically the economist was saying, look, corporations don't pay taxes. Yeah. It was a strong statement. Yeah. And basically what he's saying is any of the monies on the corporate books are basically shifted off, by the end of the year, the majority, correct? Right. From that standpoint. So you don't see a lot of cash remaining on the books at that point. It's pretty much cleared out at the end of the year. And that's basically how corporations have always ran, right? Yeah. So that being said, any increase like you were talking about is going to be significant. Yeah. The other thing we're looking at too is potentially eliminating some tax breaks for anything over $1 million. So for those making over $1 million, losing the majority of the tax breaks are some of those so-called rules that basically are available to them right now is going to be significant in a big way. Yeah. It's going to be a huge impact on their incomes. And if you're looking at small business, if you've got small business owners that are producing over that $1 million, again, you talked about the trickle-down effect. Eventually, it will come down from that level to the employees in some form or some fashion. So that's one thing we got to keep an eye out for. Also, what about the social safety nets in response to COVID-19, Brandon? Those are some changes that we're focused on too with Biden.
Yeah, some of the things that he was proposing is basically expanding the eligibility for Medicare. So right now, obviously, you're not eligible for Medicare until age 65. You can tap retirement assets at 59 and a half. A lot of people want to retire then, and maybe their Social Security kicks in at 62, 63, 64, 65, whatever makes sense for their situation. But a lot of people, if they want to retire at 60, say, well, what are you going to do about health insurance for those 5 years until you turn Medicare age, right? So that's one thing that's on the table, that he wants to potentially decrease the eligibility age to age 60. Which obviously would help a lot of people out as far as, getting that question, answering that question of what am I do about health insurance.
It's going to be very difficult to figure out how to pay for that, though, without having tax increases at all levels. It's going to be difficult in order to pull that off, but that is what he's proposing.
And that's what you say, kind of heard about, they got Medicare for all. But one of the things that is going on as far as the is the cost for the Affordable Care Act that we'll talk about later. We saw a major adjustment come in, say, March of this year in lowering. They're basically taking away the income caps. Therefore, you get a lot more subsidy prior to age 65. But again, we'll touch on that in a little more detail. But that's one thing we're looking at. Another thing he's looking at is rolling out paid sick leave protections, basically requiring employers to provide 12 weeks of paid family and medical leave through a federally funded program, and expanding the Federal Family and Medical Leave Act, or FMLA, is what a lot of people obviously know it by. So again, those are some changes you're seeing on that end.
Well, some additional social safety nets in response to COVID-19 also include providing student debt forgiveness. This one's huge. I think it's well over $1 trillion in student debt that we have out there. So some of the stipulations associated with that definitely are going to be some things that will need additional focus, but could be a huge benefit to a lot of those students out there that currently have, college debt.
Yeah, he's looking to expand that. I mean, currently the way it stands, you're just looking at there's policies that are in place now that basically protect, to say if a school got discredited or out, shut down or whatever, and a student had loans out on it, that would be forgiven. There's some public service loan forgiveness, teacher loan forgiveness. But yeah, so, those are things that's what you're seeing the money being used for now, right now. So when you look at the American Families Plan, again, $200 billion for free universal preschool, $85 billion for Pell Grants, increased to a maximum grant by about 1,400 or so. Then the $109 billion to make 2 years of community college tuition free, which is a pretty strong plan right there.
Well, it is, because most four-year, especially public colleges and universities, are accepting the community college credits during the first 2 years. So this is a way to pretty much cut your cost in regards to that education in half.
Yeah.
It's going to be a great benefit.
Yeah. Now when we get down to the individual income taxes, okay, this is, again, it's got a lot of eyes and ears open for this one. So when you look at the American Families Plan, is again what he calls it, would raise the top marginal income bracket from 37% back to basically 39.6%. All right, so when you're looking at that, you're looking at your top income earners at that point, right? So that's what he's looking at changing the income brackets for. I know when he ran for office, he was saying basically, again, back to that number we talked about earlier, anybody making under $400,000 won't see much of an increase or anything change at all. They just try really, getting the top end of those income brackets to look at the 39.6 tax rate. Also, the capital gains rate of more than $1 million in taxable income. So they're saying instead of having a short-term or a long-term favorable capital gains rate, to make it back to your regular income bracket.
Well, that too, but right now it's 15% in most cases. You get up around $400,000 or above. The number may not be exact, but it goes to 20% on your capital gains. Mm-hmm. But ultimately, there may be some type of agreement between parties to ultimately get to around 24%, or like you said, it could go back to ordinary income rates.
All right.
Yep.
And a lot of times, a lot of people ask us this question about how for them. Again, in this area, that's not a massive concern, because a lot of people's regular tax bracket of where their income's tax set, and also their, say, long-term capital gains rate, it's about the same anyways. So it's not a massive impact unless you start hitting these higher income earners. Because again, if somebody in the top bracket of 39.6% can pay a 20% long-term gains rate, that's obviously a big advantage to that group of people. So
he may also another point of interest is eliminating the step up in basis,
which would be massive.
Yeah, it would be huge. So, for example, if you have a relative that may have a stock that's got a lot of appreciation in it, they pass away, you're named as beneficiary on that particular asset, then you'll have to pay taxes on the difference between what is inherited and what the original cost basis was, not the step up or the date of death value as it is now. Mm-hmm. Income levels to where that would kick in. There's been talk that this wouldn't kick in until you had $1 million in income in the given year. We don't know exactly what that's going to look like. It's something that, again, we'll have to bring you updates as we get them going closer to the end of the year. Also, another change is they're applying the 3.8% net investment income tax to all income above $400,000, including active pass-through income. That's huge to business owners. So we're going to have to focus in on that and bring you updates as we get them. But right now, those are some areas of focus right now in what he's trying to do, increasing individual income tax rates.
Yeah. So this next page will kind of summarize what we just kind of covered as far as the tax long-term capital gains and dividends, ordinary income for taxpayers above that $1 million. So again, probably see some changes there. Again, we'll see what the real numbers come out to be. Tax capital gains for death for unrealized gains above $1 million, or $2 million for joint filers. Trent kind of touched on that a little bit.
And again, it could change.
Yeah. All this could change, right? It's always changing. Limit the 1031 like-kind exchanges by eliminating deferral of gains above $500,000. So 1031s, that's when you're looking at basically property, real estate, like-kind of real estate from that end.
Really, you're going to see just people most likely taking their profits and moving on potentially if that does change, because that's a strategy that's very often used.
Yeah, yeah. And then lastly we got on here is tax carried interest as ordinary income. And
that really doesn't come into play a lot with a lot of individuals. Really, it rolls around investment companies and so forth from that end. Yeah. But great summary there. Next slide, let's look at the history of higher capital gains rates, and really how does that impact the overall market. So what you'll see here is multiple years going back to 1969 all the way through 2013. And you'll see that the average growth of the market over that time, we're looking at the S&P 500 broad index here. So when we're looking at the S&P 500, you see a 6.6% growth rate on average when we have adjustments made to the capital gains rate. So does it really impact the overall market? No, I think it does have to digest it a little bit, and you can see some of those negative numbers within the first 3 months and also the next 3 months after that. So you've got to look at that and expect that there'll be some volatility, but think longer term. If you go out longer term, a year after it actually goes into place, as you can see on average, there's been pretty decent growth, Yeah. But if you look at it, positive, negative, statistically on this chart, you'll see 50% of the time it goes up, 50% of the time it goes down. So you're on the fence. We don't know which way it's going to go. It's just statistics tell us that it could go either way, but historically, it hadn't been that bad.
Right. The next slide that we'll look at talks about the corporate tax rate. So when we're looking at this chart basically is this, again, business income tax collections would rise to as high as levels in 40 years under the current plan. So this basically is just charting it out from 1934 all the way up to current day and beyond as far as the projections are. So you can see those changes are pretty impactful. Very beginning, obviously, at the very early stages, when you see a huge spike. Obviously, during World War II, there was a massive spike in the tax rate, and it's kind of come down and settled down since then. But if you look at the tax proposal released as part of his plan in that 2022 budget, it basically collect about $2 trillion in new tax revenue from businesses over a 10-year period of time. So a lot of money, but I don't know, it's kind of a long time period too. But
it is, and based on the amount of money we're printing on a monthly basis right now to buy our own debt, it's it doesn't look that large. It is large, but again, in the whole scheme of things. But the second point there is one that you really need to highlight, and that's talking about the revenue that this would bring in. Basically, it'd be the largest collections from businesses as a portion of our gross domestic product or our growth every year that we collected over the last 40 years. So again, corporations are getting ready to see probably one of the most impactful tax increases that they possibly could see. Does it generate the revenue we needed? I don't know, but it's going to put pressure on businesses.
Yeah. So when we kind of flow through, perfect segue into the next chart you see is another one that we found that talks about it. Hey, what happens when at the date of those taxes increase for the corporations?
Okay, so we're talking about corporations here, not individual capital gains rates. We're talking about corporate.
Yeah,
rates.
Yeah, exactly. So when you're looking at the charts on here, again, it's talking about from the 40s, 41, 42. Obviously, when you saw that big spike on the prior chart, you saw those increases. And then, what caused those increases? The name of the legislation's there. Then we say, again, let's compare it to the S&P 500 index performance and see how it performed. So you can see is, the 3 months before, there was a negative at the very first one, then positive throughout. And you see the highlights in red, right? That's kind of what you want to focus in on, depending on what you were looking at. And then you kind of look at your average returns, average return on that for first 3 months, next 3 months, next 6 months, next 12 months. I mean, it's pretty eye-opening to see some of the changes and when that year happened, but more positive than negative overall.
And really, the statistics are what the overall market does anyway. 70% of the time it's up, 30% of the time it's down. But statistically, even when we have higher corporate tax rates, again, the market has to take time to digest that. Once it digests that information and really sees how the economy is going to go, take 2 steps back. Normally it goes positive.
Yeah.
Right?
Yeah, perfect. The other question we get a lot on this next slide is talk about retirement saving changes. There's been a lot of, I think, some misinformation or some, just generalized fear about, hey, I heard they're going to take my 401k or my IRA, things of that nature. I mean, it's not going to be that harsh, but when you look at how he wants to reshape the actual retirement plans, he's wanting to make it more beneficial for lower income earners. He wants to basically level the playing field. And there's an example here. It's kind of hard to explain until you look through the example. So let's just look at it real quick. So someone's in the 37% tax bracket. So again, your highest tax bracket's out there currently. They can deduct the full amount of their retirement plan contribution. So again, since they're in the 37% tax bracket, $37 of every 100 of pre-tax contribution is what they get as a deduction off of that income. Well, if the same person did the same amount, but they're in the 20% bracket, a lower bracket, obviously, then they'd only receive a $20 deduction off each $100 contribution. So is one to try to again level the playing field from that end. I mean, we'll see what happens there. That one seems kind of far-fetched to me, but I don't know.
Well, I mean, really what we're going to have to do is we're going to have to use the new tax tables as they come about. And we're going to have to make judgment calls on what type of investment vehicles to use, because you're right. If someone's in that highest tax bracket and yet they can't deduct by deferring that money into a retirement plan, well, you're going to have to do some level of alternative. That alternative, I can't pinpoint it right now. Do we have ideas? Sure we do. But ultimately, we've got to see where these overall new tax provisions are going and what's actually put in place. But as always, if this does come about, let us know. We'll do the research for you, come back with some recommendations on what can be done to potentially set you up for a better future down the road from a financial standpoint.
All right.
Yep.
So next one we got is where we going to start giving you a heart attack. Okay, so question here for you is, where do you think the national debt is right now? Okay. Now, under normal and live scenarios, we would go straight to this website. It's the debt clock, national debt clock. You just kind of Google it, you'll find it. It'll pop up. You're looking at the debt. So guess where your guesses are, and then definitely reference that website and take a look on where it's at. You can see how fast it grows. There's a ton of information on there as well. But when we're looking at that, Trent, where are we at on the debt right now?
Just shy of $29 trillion.
Oh, yeah.
Oh, but wait. The $1.2 trillion package that was just approved, plus the $3.5 package that was additional.
That's a sneaky way. I think the Congress did that in a way.
And it may or may not show up. We don't know, depending on how they book this.
Right.
And we've talked about how they're going to fund it and so forth. But we could be well over $30 trillion in debt by the end of the year. It's almost hard to imagine how much money that is. But again, it's considerable. And we're getting to the point where Social Security and then also Medicare are really the two social benefit programs that we can afford. Right. Anything over and above that. But we do expect that to go even higher as we move forward.
Yeah. And then, again, on this chart, on this website, you can kind of see how we compare against other countries as well. And it's pretty eye-opening when you're looking at that. But, again, it's a really great website. If you can check it out. Like I say, it might give you a heart attack, but it's a good place to get some information from that end.
Well, the next chart that we've got is actually from the St. Louis Fed. You can go out there. We want to see how much money it was actually pumped into the system during the COVID issue that we obviously started to get here at the beginning of 2020. Yep. But as you see this chart, it goes all the way back to 2017. And at times, there's a need for the Federal Reserve to basically open the floodgates and get liquidity out into the system. And it's beneficial for the economy to have that money moving around. Ultimately, though, look at this chart. Go to the far right. You'll see that the actual Treasury securities that were sold by the Federal Reserve absolutely skyrocketed.
Yeah, that's just off the
So
charts
all this liquidity, people can say it doesn't tie into the market heading north or going up. There's a direct correlation.
But this is why I guess during the COVID pandemic, they kept saying there's a disconnect between Wall Street and Main Street.
Absolutely.
Right? Because, I mean, think about it. Last year, things were shut down. People were going to work. You were told stay in your house, but the market continued to go up.
So the key question, though, when you look at all this liquidity that was put in by evidence of the chart, what happens to the market if they no longer print?
Right. Well, that's when that tapering comes up, and they got to be real careful on how they do that. Right?
And that's what they're battling right now. Yeah. They're battling even saying the word tapering.
Yeah, they said it the other day, and the market just
went down 300-400 points. Yeah. When they get to the point of tapering and not buying $120 billion or releasing $120 billion into the system on a monthly basis, what happens to the market then? Right now, they haven't done anything. They're continuing to print money. So this chart, as you're seeing, that went stratospheric at last year and this year, is continuing to go up by 120 billion a month. I mean, it's pretty significant. So what happens when they shut off the printing press? We'll see. Well, we'll see. We'll see.
All right.
All right, leads us into the next chart. Let's talk about Social Security speculations. Is going to be any changes there?
Yeah, so inside the Social Security side of the equation, again, that's another one of those programs everybody's concerned about. It's always been out there. There's always been a concern, about Social Security. So when he was campaigning on change of Social Security, he wanted to increase the payroll taxes for those making $400,000 and up. So again, if you're making over that income, you're basically kind of your payroll taxes, so to speak, would increase from that end. All right. There's also a limit to where if you got to a certain level, which I believe is 140,000 or so, 144,000 or so of income, once you hit that point, you no longer have those taxes taken out. So he's looking to try to basically make that go away up to a certain level.
Yeah, I mean, he's basically wanting to increase the revenue collected from the high income earners, because right now I believe if you make over $140,000, the collection of Social Security and those payroll taxes shut down to a certain extent. And ultimately, as you earn more money, you're not funding into that system. So if they increase it up to a higher number, obviously they're going to collect more revenue.
Right.
And it's probably necessary, since the next point on Social Security is the fact that they were looking to increase the COLA, or the increase in pay, of 6.2% right now for next year.
6.2%. I mean, that's what he just said.
6.2% increase in Social Security payments through next year. You've got to collect it from somewhere. So again, there's got to be a change in some form or fashion here.
And to kind of put that in perspective, if you kind of look over the 10, 12-year average of the increase, it's been about 1.75, 1.8% or so probably increase on an annual basis, and this one comes in right at 6.2. But why are they doing that, right? Usually, some people will see their Social Security go up, but then their Medicare costs will go up as well. So they're constantly, it seems like they're chasing each other, right? But you kind of look at the past 12 months and look at what is inflation. I mean, you see it everywhere you go. You see it at the gas pump. You see it in the grocery store. A lot of clients are saying, hey, my dollar just doesn't go as far anymore in the grocery store.
Well, we talked about this. You've got rental cars year-over-year increases up 73, 74%.
If you can find them.
If you can find them. And that's part of what's driven this as far as these price increases has been so significant because of this.
Yeah. New cars, used cars, things of that nature. It's all the inflation is out of control. But that's why that COLA increase is so large.
Well, and then, just simple things like your hotel stays. Hotel costs have gone up anywhere from 20 to 21% year over year. Doesn't sound like a lot, but when you're paying $200 a night for a hotel and now it goes to $245, that's a huge difference.
Yeah.
So this COLA increase of 6.2%, I don't know how far it's going to go.
Yeah.
Yep.
Yeah. But it's something that's needed. So at least they stepped up and did it, for our retirees. That's definitely the key takeaway from that.
What about health insurance? We got some speculation around that too.
Yeah, so health insurance, this is kind of one of the things we'll pick up on what we talked about earlier. But first off, when you look at it for 2021 and 2022, there's a section in the American Rescue Plan that caps the marketplace health insurance premiums to no more than 8.5% of your household income. So again, that really helps out the lower income earners from there. Obviously, higher income earners, 8.5% of a big number is a bigger number. But this is where I was kind of talking about, is those changes that were done and put into place. So again, to kind of recap that. So again, we're talking about people that want to retire before age 65, right? You would get some type of subsidy based on what income you showed. Okay, so this was from Social Security payments, distributions from your IRA, wages, if you're still working or whatnot, or have some part-time job, all that kind of goes into a calculation. And initially the plan says if you're 400% below the poverty level, basically is where those.
That's where it starts.
That's where it started. Well, it capped at 400% was where it capped out. So you can only be 400% above the poverty level to get a subsidy. Well, what happened, which usually took you around like a married filing jointly couple, about $68,000 a year. So.
Well, what if you go over by $100 or $200?
Yeah, if you go over by $1, it just goes away completely.
You lost your subsidy.
You lost all the subsidy. So it was a very tricky scenario, and you had to be careful that you didn't exceed that and you had your numbers right. And because you put all this stuff in the year before So they can try to calculate what type of subsidy you get for health insurance. That's crazy. But
yeah, so you're virtually guessing.
Yeah,
going
you're
into
guessing.
following
You
year.
better guess right.
Right.
So, or if anything, err on the side of caution. But what's changed already this year, and we've seen a massive change with everyone we're working with as far as the health insurance costs. Again, people that are under age 65, is they kind of took away that 400% of the poverty level. So I'm seeing now even couples making $100,000 a year are getting some type of subsidy.
Yeah, paying somewhere in the neighborhood of $600-700 a year to have that health coverage.
Yeah.
In the whole scheme of things, prior to that difference, that's a pretty large savings. So it's significant. This 8.5%. The other thing this 8.5% does, it defines what your cost is going to be.
Right.
So you're able to look at that, feel good about it. Just know it's a percentage of your overall income, and it's predictable from that standpoint.
Right.
Yeah.
So again, that we'll keep it in touch with that one and in tune with the changes there. But I mean, that's a massive change. And then again, that's kind of where you're coming. In my opinion, that's where you're coming back to maybe some Medicare for all type deal,
right?
Because nobody this happened and nobody even realized it. But the government subsidizing health insurance premiums to higher income earners. I mean, or above to where they were. So. And it's indirectly, I guess, some type of Medicare for all, because you're getting some health subsidies from the government under age 65.
Well, and that's a modification going from Obamacare over to Biden care. One adjustment that Biden did make was that. Yeah. And, the savings are the fact that you can predict where you're going to be from a health standpoint, specifically not going over by $100 or $200 is a pretty nice feeling to have some defined limits.
Yeah.
And that's good. Well, Brandon, in the whole scheme of things, no two retirement plans are alike.
Nope.
All right. So what can we do going forward? What can we do based on what we're hearing out of the Biden administration and taxes and other adjustments that are going to be made?
I mean, it just comes back to making sure you got a written financial plan, you got a plan you're following, and you adapt to those changes. Again, everything that we've talked about is really legislative risk. We touched on market risk, right? Everybody kind of understands market risk. Market goes up, goes down, and everybody gets that part. But I don't think many people really understand or think about this legislative risk, and that's basically what we're looking at. This is where we are now, and we'll see what happened and what actually gets passed and actually gets put into law. But at the end of the day, I mean, it can be changed at any time if Congress has enough votes, right? That's legislative risk. And when that happens, you got to reassess your plan. You got to say, hey, how much money am I making on an annual basis? Is that going to change anything? Do I need to do Roth 401k or pre-tax 401k? If I'm in retirement, do I need to pull from taxable accounts? Do I need to pull from pre-tax accounts? Do I need to pull from a Roth bucket, right? So again, that's why we always like these different buckets of money, so to speak, to pull from. Because it really depends on what tax rates are out there and which way we go. So
continue to work with us as financial advisors. We want to make sure that plan's update, but every year it's not a static concept. It's something that moves at all times, and that's why we want to make sure we've got it updated and focus in on that. But stay informed also. We've got several communication channels that we use, and a lot of it's driven on social media. So make sure that you subscribe to our channels. Make sure that you read our white papers that we send out. The blogs that we send out have good information in it. And if it generates questions, always reach out to us. We'll be proactive and get back to you and try to steer you in the right direction from that standpoint. Anything else, Brandon, that you would like to add?
Yeah, I mean, like I said, we're big on education and just trying to keep people informed. And everybody learns a little differently. Some people want to sit down and talk about it, have a phone conversation, watch these videos, read articles, whatever it is. But we also have podcasts that are out there as well. That's pretty informative. We have some fun with and try to get some information out there to people that like news that way. So again, we try to anyway to try to get this information out to it because it's super important and it affects a lot of decisions. So again, if you got any questions from everything that we covered today, obviously get in touch with us, call us, email us, whatever it may be. Go to our website. We got a lot of information on there as well. But thanks for joining us today. Hopefully we'll get back to doing this stuff in person again. But again, as always, keep us in mind, and we look forward to talking to you next time. Brandon Rogers and Trent Bradshaw with Bradshaw Financial Planning and Mind Your Money. Take care.